So in this final part of this video on introduction to portfolio management, we want to introduce what's referred to as the capital market theory. And this is kind of the foundation, if you will, of some of the asset pricing models we'll talk about in later videos. But the capital market theory extends Markowitz's efficient frontier concept to include a risk-free asset. It includes borrowing and lending. Since risk-free assets implies treasury bills, we can either buy or sell treasury bills, which is borrowing and lending. It also requires market equilibrium, that the markets are currently at least stabilized. So this is going to simplify our portfolio choices dramatically. Instead of thousands of efficient portfolios, investors are now going to focus on only two things. There is one portfolio that is the best risky portfolio that you can buy, and that's what we're going to refer to as the market portfolio. All investors will invest in one of two things or combinations of two. They will purchase or invest in the risk-free assets, and they will invest in the market portfolio. So the assumptions that we have, there's lots of assumptions in all theories, but in general, right, the assumptions we have is that all investors are efficient investors, that they want to be on that efficient frontier. Again, it makes sense that you want to be or have the very best portfolio you can get. It assumes that investors can borrow or lend any amount of money they want at the risk-free rate of return. Investors can lend at the risk-free rate of return because you can buy T-bills. You can buy as much as you want. The challenge, though, is individuals and companies cannot borrow at the risk-free rate. 3, all investors have homogeneous expectations. That is, we all see the exact same data and we all have the exact same opinion. Again, we all see the same data, but as individuals, we do not act in a homogeneous nature that is everybody acting the same way. And then finally, all investors have the same one-period model. So whatever your period is, 1 month, 6 months, 1 year, everybody has or acts on or with a concept of a one-period model. In addition, all investments are infinitely divisible, right? Now, this is a little bit more possible now for stocks and bonds more than previous, but certainly is not for all assets, right? So your house is considered an asset. It's an investment that you make. You can't divide that in half, right? Says there's no taxes or transaction costs. We know that's not true. It says there's no inflation rate or there's no changes in interest rates. We know that that is not what we see in real life. And then finally, capital markets are equilibrium. What that means is that all investments are properly priced in line with their risk levels. Again, markets go in and out of equilibrium frequently. So what does this mean, right? We need to develop what we refer to as the capital market line. Risk is measured by standard deviation. We know that a risk-free asset exists, and that risk-free asset has a standard deviation of 0. So the capital market line shows the best risk-return combinations available. Portfolios are formed by mixing the risk-free asset with the market portfolio. So very conservative investors are going to lend at the risk-free rate. That is, they'll purchase treasury bonds. Aggressive investors will borrow. But everybody holds the same risky portfolio. Everybody holds what we refer to as the market. So we need to know the covariance of risky assets with the risk-free asset. So because if the returns are certain, if returns are certain, covariance and correlation between risky and risk-free assets should be zero. So that correlation or covariance between any risky asset, between the market portfolio and the risk-free asset, covariance and correlation should be zero. So here's a few formulas to kind of get us thinking about how we calculate risk and return. So here are the formulas for return and risk, right? So if you want to know the expected return in a portfolio, how much did you invest in the risk-free? How much did you invest in the market portfolio? How do we calculate standard deviation? Well, if you remember, we had a previous formula, standard deviation, that had the correlation between the asset and the two assets in the portfolio. Well, in this case, we've already stated that because one of these assets is the risk-free asset, the correlation is zero. So if you want to find the standard deviation of this portfolio that has risk-free and risky in it, the standard deviation is 1 minus the proportion of the risk-free multiplied by the standard deviation of the market. So again, also what ends up falling out here, obviously, is the riskiness of that risk-free portfolio. I mean, it didn't fall out. The answer is it's just zero. So now we have these combinations, right? So we can do the expected return in the portfolio is the risk-free rate, plus again, we have the standard deviation of the portfolio multiplied by, here we have again what's referred to as the risk premium, the market minus the risk-free rate divided by the standard deviation of the market. We can do a little bit of algebra here. We end up with the standard deviation of the portfolio divided by the standard deviation of the market times the, again, market risk premium. So again, this relationship is going to hold for every combination of risk-free asset with any collection of risky assets. However, when the risky portfolio is the market portfolio, right? This linear relationship, this formula, is what we refer to as the capital market line. Now, how do we find this capital market line? Let's go back to the efficient frontier. That's this curve here. The capital market line is a combination of the risk-free asset out here on the vertical axis and the market portfolio. That is M, this market portfolio here. If you kind of think about a line or a ruler that has its axis point on the risk-free asset, if you just let that ruler fall down and lay on this efficient frontier, it's going to touch the market portfolio there. So that then gives us what we refer to as the capital market line. So if you are an investor, what do you choose to buy? Well, you're always going to buy some market portfolio. That's the risky asset that you hold. However, you're going to combine that with an investment in risk-free assets. If you if you're very sensitive to risk, if you have high risk aversion, then you're going to be down here and you're going to buy treasury bills and you're going to buy the market portfolio. You'll have positive investments in both. But if you're aggressive, what you would do is you would borrow at the risk-free rate. You would borrow treasury bills. That means you would be lending at the risk-free, or excuse me, borrowing at the risk-free rate, which means you're getting money, and you'll take that money with all the rest of your money and invest it in the market portfolio. So again, we've kind of simplified this model, saying, look, people only buy two things. They buy risk-free, or they invest in risk-free, and they invest in the market. Everybody owns the same two assets. What you choose depends on your risk aversion. So again, this market portfolio contains all risky assets. It's fully diversified. There's no unsystematic risk. So again, only systematic risk remains. So that's risk that's driven by economic forces like interest rates, inflation, economic growth. So this insight, right, into this relationship now leads us to the capital asset pricing theory and pricing models that we'll come across in later videos. So what has happened here with this capital market line, since we have risk, diversification, we have this market portfolio, the only systematic risk in the environment is the risk of the market portfolio, and that is systematic risk. It's the variability of all risky assets caused by macroeconomic variables. Supply of money, interest rates, variability in things like industrial production, corporate earnings, and cash flow, that's not incorporated into this systematic risk, if you will. So we end up with a graph that we've seen many times in other videos that shows as we invest in more and more assets, the diversifiable risk goes away. It reduces, but it only gets to a certain point. Somewhere around 20 to 40 variables or shares is where we're going to have the least amount of risk, which will be entirely systematic risk. All other risk is diversified away. What this theory, what the capital market line theory provides us is something called the separation theorem. This states, as I've mentioned earlier, everybody holds a portfolio that is a combination of only two things, the risk-free asset and market portfolios. But what proportions? Those proportions are based on the investor's risk preferences. However, again, maybe it's not totally apparent. The only risk that matters in this situation is systematic or market risk. Now, let's think a little bit about continuing to talk about risk. What is the risk, the variance of returns for this risky asset? We can calculate that, right? That the variation of the portfolio is the variation of the formula. Here's the formula for the capital market line. So we need to know the variance of alpha. We need to know the variance of this market relationship, and we need to know the variance of the risk that's taken. So the overall variance of an asset has two parts, systematic variance and unsystematic variance. Because of the math, as we incorporate and add more and more assets into the portfolio, this estimation, right, this estimation error. It ultimately is diversified away. It goes out of existence. So again, it's not related to the market portfolio. So this indeed is what we actually refer to as the unsystematic or the unique risk, because it comes from the unique factors or elements of the company. So we need to solve for the weight of the risk-free asset, right? How do we invest? How do we use this? So let's say that the weight of the risk-free asset plus the weight of the risky asset has to add up to 1. We're going to invest all of our money. So the weight of the risk-free is also equal to, or if we do a little math here, 1 minus that weight is the weight of the risky asset. Again, that has to equal 1. So here we have our formulas. You have 4% is our risk-free asset. The market portfolio has a 9% rate of return. The standard deviation is 10%. So how would you go about investing your money so that your investment would have a risk level of 11.5%? So how would you solve this so that we could get an 11.5% standard deviation? So we want the return here to be 11.5%. 4% is the risk. Again, we're solving for W here. So if we do the math here, we end up solving for the weight of the risk-free asset is negative 0.5. So that means is I'm going to borrow 50% of my money and I'm going to invest 150% of the money. So let's think about this another way. Let's say you had $10,000. What this tells you is you're going to borrow $5,000. You have $10,000. You just borrowed $5,000. You're going to invest $15,000 in the market portfolio. So this, again, kind of illustrates this idea of what we refer to as the separation theorem. Everybody buys the same risky thing, but the risk that you take, the benefit that you receive, depends on your risk aversion and how much risk you're willing to assume. So what is the big takeaway from these last set of videos? Risk has to be evaluated at the portfolio level. Diversification depends on correlation, not asset quality. Efficient portfolios dominate inefficient. All rational investors are going to hold the market portfolio. Risk preferences determine whether you borrow or have lending behavior. In the next videos, we're going to develop the statistic or the metric called beta. Hope to see you the next time. Bye-bye.